The stock market just did something it does almost every January. It rallied. The S&P 500 is up 1.6%. Small cap stocks, the Russell 2000, are up 4.6%. That's the biggest gap we've seen in years. And this pattern is called the January effect. But here's the question. Is it real? Or is it just folklore that Wall Street uses to get you to trade more? And more importantly, is it actually happening right now in January 2026? Let me break down the data. The January effect is one of the oldest patterns in stock market history. Investment banker Sidney Wachtell first identified it in 1942. He looked at stock prices dating back to 1925 and noticed something. Small cap stocks consistently outperformed the broader market in January, more than any other month. What's the evidence? Over the past 20 years, January ranks 8th
out of 12 months for average returns. That doesn't sound impressive. But historically, when the S&P 500 rises in January, the full year ends positive 82% of the time. When it falls in January, the year ends negative only 54% of the time. That's barely better than a coin flip. So the January effect is real statistically.
But here's the catch. It's weakened significantly in recent decades.
There are 5 main reasons the January effect happens. Number 1. Tax loss harvesting investors sell losing stocks in December to offset capital gains and reduce their tax bills. This creates selling pressure in December. Then in January, they reinvest that money, creating buying pressure. Stock prices rise. Number 2. Year-end bonuses. Companies distribute bonuses in December and January. Employees invest that bonus money in early January. New capital flowing into markets equals prices going up. Number 3. Institutional rebalancing. Fund managers rebalance portfolios at year-end, locking in gains. In January, they deploy fresh capital to new opportunities. Small cap stocks especially benefit from this institutional capital flow because they're less liquid. Number 4. Psychological optimism. New Year psychology. People make New Year resolutions, including investment resolutions. They buy stocks with fresh confidence. January optimism drives buying. Number 5. Mean reversion. Stocks oversold in December often bounce back naturally. This natural recovery combines with all the buying pressure, exaggerating the effect. The result? A self-fulfilling prophecy where January becomes a rallying month almost by design. So is the January effect actually happening in January 2026? Let's look at the numbers. S&P 500, up 1.6% in first week, positive, but not massive. NASDAQ 100, up 2.2%, stronger than S&P, following tech outperformance pattern. Russell 2000, up 4.6%. That's the smoking gun. Small caps up 4.6% versus large caps up 1.6%. That's a 3% spread. That's classic January effect. It's literally textbook. Small cap outperformance is happening right now. Why January 2026? December 2025 was flat. S&P down 0.1%. So we had selling exhaustion, which creates the setup for January recovery. Now we've got tax refunds coming, bonuses being deployed, and institutional rebalancing happening. So yes, the January effect is real, and it's happening right now in 2026. There's something called the January Barometer. It says, if January is positive, the year will be positive. The data shows, when January is positive, the year ends positive 82% of the time. That sounds impressive. But when January is negative, the year ends negative only 54% of the time. That's barely better than random chance. So the January Barometer has asymmetric predictive power. It works great when January is positive. It barely works when January is negative. This year, January 2026, is already positive. So statistically, there's an 82% chance 2026 ends with positive returns. That's a good omen, but it's not guaranteed. The bottom line, January effect is real for small cap outperformance. The January Barometer is somewhat predictive for year-end performance. But neither is a reliable trading strategy you can profit from. Why? Because even when the January effect occurs, the returns are too small compared to trading costs. You'd spend more in commissions than you'd make. That's why the effect has weakened in recent decades. So what does this mean for your actual portfolio? If you're heavily in large cap tech, the January effect suggests rotating some exposure to small caps early in the year. Historical patterns suggest small caps will outperform. If you're in small caps already, you might want to lock in some January gains before February hits. The data shows February often reverses January's gains. In 2023, January was plus 4.51% and February was minus 4.02%. That's an 8.5% swing. For your overall portfolio, the fact that January 2026 is off to a positive start is a good signal for the full year. 82% of the time when January is positive, the year is positive. That's worth noting. But remember, strong economic fundamentals matter too. The Fed is cutting rates, GDP growth is strong, unemployment is stable. For traders, don't try to exploit the January effect with day trading. The returns are too small and transaction costs too high. Instead, recognize the pattern, understand small cap outperformance when you see it, and make strategic allocation decisions around it. And remember, the January effect is a pattern, not a law. It doesn't always happen. So use it as one data point, not your entire investment thesis.